Hey, dividend investors, welcome back to Dividend Talk. My name is Derek, and today I'm going to talk to you about Unilever. Those of you who listen to our podcasts will know that we often talk about Unilever as being a top quality dividend company. They're certainly top 5 in my own portfolio, and European DJI is invested in them as well. However, over recent years, they've been a little bit static. Management has made some poor decisions, and now they've kept their dividend flat. So the question is, are we wrong about Unilever? But before I get into that, if you like this channel, if you like our podcast, and you want to see more videos like this, please consider liking this video and possibly subscribing. See you on the inside. So let's dive straight into Unilever's dividend history and see how the company has performed over the years. As you can see from their investor relations page, they give you a history as far back as 1999. Up to about 2020, this was all reported in pence, so they were growing their dividends in pence. Since 2020, they unified their legal structure to a single parent company called Unilever PLC, which is headquartered in the United Kingdom. But if you're like me and you own the shares on the Amsterdam exchange, you receive the dividends in euro, which is quite good. Although they have history here up until 99, my buddy European DJI has done a video of these. Now this video was done back in 2020, I believe, but he has them growing dividends since 1966, which would be a dividend king if you were to think about it. It's well over 50 years, and they've continuously grown them. For European stocks, we look at it a little bit different. It's growing or keeping it static, so there's been no dividend cut since 1966 for Unilever, which is quite a strong record for a European company, I have to admit. I think it's fair to say that over the years the company has steadily increased its dividend payouts, so it does reflect their commitment to rewarding us, the shareholders. The past decade, Unilever has seen its dividend payments grow at an average rate of about 4 to 5% per year. One thing I will note is that I use Kyfin when I'm doing my initial research on companies, but it's not always 100% correct all the time. I actually struggle to find a single platform that can correctly display European data correctly all the time. It's a constant battle, but it is quite useful, particularly for US stocks, but also to give you an overall trend. The trend is usually in the right direction, but you can see here the 5-year annualized growth rate for dividends, and the 3 and the 1 year we see a decline. That's not correct, and it's obviously in and around when the corporate structure changed from a dual listing to a single listing. So I would always encourage you to do your own research, particularly with European companies, and go into the annual reports, and we'll see that later. We might look at some numbers, but I just wanted to highlight that out. What is correct though is that their dividend yield is 3.65 at the moment. So they pay out roughly 170, 171 if you round up in dividends per year. The share price is €46 on the Amsterdam exchange. So the dividend yield is correct. So it's a relatively decent dividend yield, and with an annualized growth rate of about, say, 3.5 to 4%, whether you're looking at a 5-year or a 10-year period, it's a quite decent return from a consumer staples like this as well. So their history is quite strong, and they have a proven track record. And for income seekers like me, who's historically looking for around 8% return, 8 to 10% return on companies like this, I'm happy with both the high dividend yield and their dividend growth rate. And certainly you can compare them to someone like Procter & Gamble, who have a slightly lower dividend yield of around 2.5, 2.6%, but they would have a better dividend growth. I think it's around 6% to 7%. But you're roughly getting in around the same return based on a dividend yield and a dividend growth. So from that kind of a standpoint, Unilever look like a good bet. I mentioned during the introduction that Unilever has been a little bit static over the last maybe 7 to 10 years. And if you look at the share price, you can see that the share price has pretty much been the same since around 2017. So whether you bought it in 2017 or held it now, there's been no real difference in the share price. Now it has gone up and down as normal market goes, but you can see the general trend is flatlining. But that's not what I mean when I talk about the company being static. We are dividend growth investors. So what I like to look at is the underlying business. I like to see revenue growing, earnings growing, and also free cash flow growing. And if we were to jump back into Kyphin and have a little look, you can see that earnings since 2010, 2012 has been pretty much flat. Little bits up and down, but it's pretty much flat over that time with no real growth. We also see the same trend with earnings per share. Dividend per share is going up at a slower rate, and same with free cash flow. We do have a bigger jump this year, and we'll get into this year's annual figures later on in the episode. But a lot of that is driven by inflation and increasing their prices. But as far as the company has been over the last 10 years, it's pretty much been static with no real growth. And that can be a little concerning, particularly as a dividend growth investor, where you need to see free cash flow growing, or you need to see earnings growing if they're paying it from net profits, in order for them to continue raising that dividend. And I mentioned before, I'm looking for about an 8% return. And with these guys with a 3 to 4% yield, I need them to be increasing that dividend year on year for me to reach my financial goals. For me, one of the main reasons for this stagnation is increased competition within the market. More and more players such as L'Oreal, Nestle, Procter & Gamble, they're entering and fighting for the same market share within the consumer goods industry. Unilever is facing greater pressure to maintain its market share and stay ahead of the curve. This has made it pretty difficult for a company of this size to grow its revenue and free cash flow at the same pace as it has in the past. And if you look here, this is Euromonitor International. Just even look at the headline: Unilever lost overall share in beauty and personal care market in 2021. So I think this gives you an indication that they are in quite a competitive landscape, and within that, market shares is quite important, particularly if they're going to be trying to increase their revenue and net income. Another factor for me is pretty much the change in consumer landscape. Everything is going digital, everything is online, and the rise of e-commerce and direct-to-consumer brands. Traditional consumer goods companies like Unilever are facing challenges to try and engage its target audience, and even trying to change their bricks and mortar business into an e-commerce and a digital business is quite challenging for them. In my opinion, this is something that Unilever has been quite slow at. They are starting to get to grips with it, but as I said, it does impact a company like this when they're so slow, and newer players into the market can certainly get a foothold a lot quicker into the market by offering these types of services. And also, we can't forget then that the pandemic, we did have a pandemic in 2020, which stifled a lot of these companies, but we are coming out of that. It's nearly fully in the rear view mirror right now. And with inflation, we're starting to see some tailwinds in terms of pricing power and pricing growth from Unilever, but the expense of that comes obviously volume, as less people will buy it, and they might also be giving up some market share on that. So there's a lot of different variables at play, but certainly over the last 10 years we can say that they've been quite stagnant, and the question is, can they produce growth going forward? What are their growth drivers, and where will that growth come from? One of the key critical factors with Unilever, I feel, over the last 5 years or so has been their management. Their CEO, Alan Yopi, has been under serious pressure the last few years, particularly with the share price going nowhere. Investors were not really happy, and then some of the decisions he was making were quite questionable. But even before his time, if you look back as far as 2016, you can see that Unilever, they bought Dollar Shave Club, and I think they paid $1 billion for a company like this. At the time, there was a lot of mixed reviews about that, but it was seen as an attempt to enter the fast-growing men's grooming market, but it was heavily criticized as being overpriced, and something now that we can probably start to see that they did overpay for this type of company. This has been quite a costly acquisition for the company, and it had to write down some of the value of the acquisition and try and make significant investments to try and turn it around. And that's bad enough, but then you have Alan coming in and he makes a similar mistake. he goes and tries to overpay for GSK's spin-off, which turned out to be Haleon. They again they wanted to put in an audacious amount of money for a company of this size. Luckily, GSK helped us out a little bit as shareholders and completely rejected the takeover bid. And I was quite happy with that. I didn't see how this company would fit in with Unilever, but it did seem quite desperate from Alan to try and force his way into a market, and there was a lot of backlash over that. And I think after that, there was an activist investor, Nelson Peltz, came onto the board, and I think that really started to put the pressure onto Alan. And I think this decision alone has been key, maybe in forcing him to step down, and a new CEO, Hein Schumacher, will step into his place. Also coupled with that, we had some news around Ben & Jerry's, which is a huge ice cream brand for Unilever. But I think Ben & Jerry's announced that it intended to end its franchise deal in Israel at the end of 2022 as a means of stopping its product being sold to occupied Palestinian territories. This was kind of at odds with what Unilever wanted, and there was a bit of to and froing about that quite publicly, I must say, which was a little bit embarrassing for the company. It ended, there was lawsuits, but it also ended where Unilever has sold or let go its Ben & Jerry's business interests in Israel to Blue and White Ice Cream Limited. So again, that was just something quite embarrassing for the management, and it just did not have a good look, particularly as there was politics involved, and I don't think it should have been played out in a public sphere like it has. There's other aspects too that management are heavily criticised for, particularly, as I mentioned earlier, their sluggish response to the shift to e-commerce, which we know is going to play a major role in our futures. They've also been focusing on sustainability and social responsibility, which is not always a bad thing, but it has been criticised by some investors, particularly as it takes away from their main goals. And with everything being so static over the last 10 years, a lot of investors feel like that they should be prioritising growing the company from within. But all this kind of helped to, I would say, push Alan Yopi out. I know he walked, but I feel like he was gently nudged out the door. With that, we will have a new CEO, Hein Schumacher, which is a great Formula 1 name for anyone that likes Formula 1, but he's going to step in as the new CEO. And I think he's going to come under a lot of pressure straight away to try and improve margins, improve growth, and get this company back on track. I don't really know a whole lot about Hein as a CEO, and I need to do a little bit more research on him, but he certainly has his work cut out from with Unilever. In saying that, not everything Alan has done has been pretty bad. He has tried to undergo a strategic shift to focus on high margin products and offload low margin products in order to improve its financial performance and try and deliver value to us, the shareholders. This shift to high margin products has involved divesting some low margin businesses and investing in areas that have larger potential for growth and profitability. This has included selling off non-core businesses and focused on high margin categories such as personal care and well-being and home care products. These have a strong demand and they do have more potential for growth and profitability. So some examples of the non-core businesses that Unilever has sold in its past: it sold its spreads businesses. So if you think about brands like Flora and Stork, they sold this company to KKR for about 6.8 billion euros, and this was part of Unilever's effort to simplify its portfolio and focus more, say, on personal care and home care. In 2018, they announced that they were selling its soup business, which included brands like Knorr and Lipton, to McCormick. They also announced that they were selling some prestige cosmetic brands, and recently they announced in 2020 that they were going to be selling PG Tips as well. So let's take a look at their 2022 annual results. Now, they don't have the annual report out, but they do have their numbers and their highlights there, so we can take a little look at them. And you can see straight off the bat that their underlying sales growth was up 9% year over year, with each segment, beauty and well-being, personal care, home care, nutrition and ice cream, all doing reasonably well. We'll see later on, a lot of this is down through pricing. So with inflation, they are increasing their pricing quite a bit to pass on those costs to the customer. This will come at the expense of volume, so you will have less people buying your products, and then you will also lose a little bit of market share. But again, we are seeing some growth, but particularly because their pricing is so aggressive at the moment. We also see underlying earnings per share decreasing by 2.1%, and also free cash flow decreased as well to 5.2 billion. They do have a share buyback program, and they bought back roughly 1.5 billion shares during 2022, and also maintained their dividend for 2023. So if we look at their commentary, earnings per share decreased by 2.1% to €2.57. This included a positive impact of 6.1% from currency. So if you were to take currency out of it and it was actually constant currency, it would have decreased by 8.2%. This is mainly due to a higher tax rate and lower income from their non-current investments and finance costs. They also noted that their diluted earnings per share was up 28.8% to 2.99, and this is because of a 2.3 billion gain for the disposal of Ekaterra, and also actually included impairment charges of 192 million related to Dollar Shave Club, which we mentioned earlier. Free cash flow was down, and they're telling you free cash flow was down due to increased capital expenditure and working capital. And we're also going to see that inventory, which is quite a trend actually over the last 12 months, inventory has gone up quite a bit as well. So if we take a look at their income statement for a moment, you can see, as I mentioned earlier, turnover was up quite significantly this year. So it was up to 60 billion thereabouts. And if you look at the reason for that, you can see that their sales growth, it's known as USG on their annual reports, was up 9%. That is made up of pricing growth of 11.3%, but you can see that the volume growth is down 2.1%. And that's to be expected. If you're going to increase your prices, particularly due to inflation, you can expect some level of customers to move to cheaper alternatives. And you can see that. I can see that even within my own household. If you do some shopping in maybe one of the bigger brand supermarkets, say like Tesco's, you might start to shop a little bit more in the likes of Lidl and Aldi, which will give you more discounts and come away from some of the bigger brands. So that is to be expected. The question is how long can they increase their pricing like this for? We know we've kind of reached peak inflation at the moment, and there is talks that this might come down, particularly with rising interest rates. But the question is, have we reached peak pricing? So it'll be interesting to see how they will try and win back some of this market share that they might have lost. What was interesting to me was to see that in each segment we saw volume loss in around 2 to 4% across the different segments, but beauty and well-being actually saw a slight increase of 0.3%. So that's actually a decent performance from them, particularly as they were increasing prices in around 7.5%. Not as aggressive as home care, for example, but they are increasing prices and still holding on and actually increasing slightly their volume. And this is also without Europe and China fully lifting their restrictions. More so Europe, but China is still a little bit restricted. So I'd expect this segment to do quite well, particularly as China starts to open back up. If we look at the balance sheet for a moment, we can see that goodwill and intangible assets make up around 40 billion, and that's over 50% of its total assets, which is a little bit too high for me, and it's something that I would like them to bring down, particularly goodwill. As we know, this company likes to overpay for its assets, particularly as it's trying to turn around and move into higher margin businesses, but it's still a little bit high for my liking. It's not a huge concern, but it's just something that I would note, and it does get a little bit of my attention. We can see in their current assets, inventories have been going up, and this is a theme that we've seen across lots of different industries and companies throughout these annual reports over the last couple of weeks. So I'm not concerned, I'm not surprised to see that. We've also seen cash and cash equivalents go up as well, which is not a bad thing. What I don't really like though is their long-term debt to equity. You can see their non-current liabilities here. We can see financial liabilities is 23 billion and their equity at the moment is 21.7 billion. To me, that's a little bit too high. I don't like to see this on a balance sheet. However, what I will say is that Unilever's interest coverage rate is around 12 at the moment, so they can easily afford to pay down that debt. I would rather them actually start paying down that debt a little bit more than buying back shares. And as we've seen, they have maintained their dividend, which I don't really disagree with particularly, but I would like to see them paying down this debt a little bit more. As I said, it's not overly concerning, but it's just something to note, particularly as interest rates are rising. When we had a low interest rate environment, it's not really a problem. You can buy cheap money and you can pay that back over long term. But as interest rates rise, the cost of debt goes up, and that's when it can be a little bit of a concern. But at the moment, their interest coverage is sufficient to cover their debts. I'm happy that they're able to meet their financial obligations. It's just a little bit on the high side for my liking. And finally then we have the cash flow statement, where we can see operating profit has gone up, but we also see an increase in working capital, which I explained a little bit earlier on. So the question is, are we wrong, or am I wrong about Unilever? So first of all, we need to understand, are they good value? So look at their core market growth. Unilever sells soaps, ice creams and other products that people are likely to keep buying forever and ever. These will probably stay in line with global economy, which has grown roughly in around 3% every year over the last 50 years. So I don't see any reason for this not to continue into the future. I've mentioned that they're going into high growth markets. They have a significant footprint also in emerging markets, as well as 40% of revenue is coming from the likes of India and China and US. Underlying sales growth in India and China has been in the high single digits for the last 5 years, and I expect this to increase, particularly as China begins to open itself up after the pandemic. If you look at their dividend cover, the EPS payout ratio is around 57%, and the free cash flow payout ratio is around 65%. The free cash flow payout ratio is a little bit high for my liking, but it is under my required 70%, and actually the two earnings per share are in and around the average over the last 5 years. I don't see any reason why they can't maintain this, particularly as they increase on average around 3 to 4%. So if their core market growth can keep up with around 3%, and then the higher growth markets can give us another 3 or 4%, they should easily be able to cover their dividends. And as I said, over the long term, I think an assumed growth rate of around 4% is manageable and can be maintained forever. And I have forever in brackets because nobody knows what will happen in the future. If you look at the dashboard that pretty much European DGI built and designed, and then I add some data to it as well, most of the key statistics the company performs reasonably well in. They've got a great track record in dividend growth. Their dividend yield is quite attractive, particularly if you compare to some of our US peers and even the S&P 500. The dividend growth on this is around 5.9%. I have it slightly lower, but it's still sufficient given their dividend yield. The earnings per share and free cash flow payout ratios again are manageable, and if you look at the price to earnings, the PE ratio, it is actually quite attractive if you were to compare them to the likes of Nestle and to Procter & Gamble. So from that perspective, they might be a little bit undervalued compared to their peers, but again, management is a lot better on those two companies that I mentioned than Unilever, so that's why you're probably going to pay a little bit extra for them. They have a strong credit rating, an A1 credit rating, which is good, but also, as I mentioned before, their debt to equity is a little bit on the high side. It's not a huge concern, as I believe that they can manage it quite well, but it's something that I would like to see the company bring down over the next few years. And again, we have a fair value calculator in here. I would ignore my calculations. Again, it's based on my assumptions and my assumptions alone, but I think this company is in and around a fair value price. So my fair value price set here is about 43%. Sometimes I add a 10% safety net onto that as well, which would reduce that even more, in around the €40 mark. But honestly, I think they are not overvalued by a huge amount. So if I didn't own any shares in Unilever, I would maybe start to consider them in around €45. But at the moment, I have enough shares of them. So am I still holding? Well, Unilever has been in my portfolio since around late 2020, and honestly, I have no real intentions of selling it just yet. Obviously, management is a concern, and the lack of growth is also sometimes concerning, but I honestly think that it is a high quality company. It owns some really strong brands, and I do like that they are divesting some of the lower margin brands and investing in the higher margin markets as well. So I think there's still a lot to like about this company. I also expect it to pay and produce a steady dividend income for many years. What that growth rate ends up being, I don't know, but with a 3.65 dividend yield, which is in and around what I got them for, I only really need around a 4 or 5% dividend growth rate to meet my targets. I do have other companies that have slightly higher as well, so that kind of offsets it, but I honestly think that it is going to give me a decent return, and I also think, as I mentioned, that they are reasonably attractive at its current price. But it's not super attractively priced, at least by my standards, and although I'm happy to hold Unilever, its position is a little too large in my portfolio. It makes up around 7% of my portfolio. Honestly, I'm in the accumulation stage, as it's called, and my portfolio is relatively small, so it's not hard to build up a large position quite quickly. But what that means is I simply will not be adding any more to Unilever, even if they drop by another 10, 15, 20% and become super attractive. I will not be adding to this position until I build out some more of my core positions. But there you have it. In my opinion, I don't think we're wrong. I think that the company has a lot to like. There's a new CEO coming in who will be under pressure to start delivering to their shareholders. So it'll be interesting to see. I'm certainly going to be holding these for the next 3 to 5 years, but I'll be keeping a close eye on this new CEO, particularly around the dividend policy. If that changes, then I may start to change my mind on this company. Actually, I probably will. If they were to cut the dividend altogether, I would no doubt not be invested in this company, but for the moment I am quite happy to hold. Let me know your thoughts. As I said, I'm quite new to YouTube, so I'm just really finding my feet, but I appreciate any comments, and we will see you all soon.